All right, everyone. Welcome back to We Hate Money, episode 5.5. We got King, we got Wizard, we got Arnie. How are you boys doing?
It's been an adventure.
Life is beautiful, like a box of chocolates, as far as Gump would say. So, well, you had a bit of an adventure lately, Wiz.
Just work normal work stuff, and then I decided to become more active trading again. That might be a mistake, but we'll see. But yeah, I'm pretty excited for the last let's see here, 3 months coming up. Well, 2 months really. We're almost out of this month.
Yeah, true, man. Time is flying, and October, the day of reckoning that you predicted is looking more and more likely. So, we'll see how we go. King's in South America. How's South America treating you, mate?
Yep. Yeah, South America via Canada. That was great. Decided to try some international travel. And found out that Canada is just like the US. Same inflation and crappy snacks at gas stations. And just pretty much trying to enjoy every day I have until I finally slip into complete and utter senility.
Oh, that's a long way off, I'm sure. I imagine Canada to be like America, but with way more moose, way more Mounties, a lot more poutine, lot of maple syrup, you know?
I think that's true.
So,
It's a lot.
Well,
Well,
apparently somebody's never been to Vermont. Okay, so
depending on which part of the U.S. you're at, yeah, I guess that would be it.
well, today, boys, we're going to discuss yields again. I think we discussed this last pod, if I am not mistaken, but I can't remember because it's been like 2 weeks. But yeah, we're going to discuss yields because a lot going on in that space, and obviously directly correlated to what's happening in the stock market.
Yeah, so I mean, 30 years now up to 4.65%, and 2 years at 5.15%. I don't mean that, who knows what it could be at right now. I'm sure my data is like an hour old and I'm completely wrong, but yeah, it's making equities not look so attractive if yields keep going up. I mean, why
Yeah.
risk your money?
Well, I actually saw an interesting article the other day that said that like if you go back in the really long term, like hundreds of years in the USA, the yields are actually at their average at the moment. Like this is where they're supposed to sit. But obviously in recent memory, it's been nothing like this. So this feels like high for us. But it's an interesting conversation to sort of think, like, is this a return to average? And is this where they should sit long term? Does that mean that like yields are going to go higher and higher again ahead of this and then come back down to this average? Like, it's an interesting way to frame it. But I mean, conditions now obviously different to the last 200 years, very different. So what will happen if yields continue to rise? Sounds like total Armageddon to me. I don't know.
Well, I don't know either. I guess we'll see. So far, everyone seems to still have this idea that we can. I hear from people that, oh, we're gonna end with SPX up at 5,000 or something at the end of the year. I think that's been the continual thing I've heard from people who are hyper bullish, is we're going to get to 5,000 at some point. And I don't know, for end of year target, that's looking kind of suspicious. I think 4,500 would make more sense if if everyone's okay with higher yields and still wants to buy equities. So it's completely possible.
you ever been in a junior high school lunch or gymnasium when Taylor Swift cancels the local concert? I expect that when yields hit 5%, that's probably about what it's going to look like.
Out of chaos.
Food just flying everywhere, crying. People generally just having a bad day. Yeah. Unfortunately, I get what they're saying, but we're back to like a more average real yield. Unfortunately, we're not in a situation where we can actually sit on a pivot point like that anymore. Um, as the as the cost to the government's debt continues to go up, they have to issue more debt in order to pay for the debt they already have, and that's becoming this to be almost a snowball effect. So as the debt servicing approaches almost $1 trillion a year in interest payments, we're getting to the point where they're issuing debt just to satisfy those interest payments, which is then pushing the yields higher to have to then issue more debt to satisfy the interest payments. Something has to give. We talked about this like a year ago. Jerome Powell is
2 years
kind of
ago.
stuck. Yeah, even 2 years ago, right? Yeah, he's kind of stuck. He's stuck right now because he has to fight inflation, but at the same time, he's making the Treasury's job very, very difficult. Like the Treasury is having a really hard time figuring out, like, how are we going to fund the government? Like, we're getting to the point where all of our money that's coming in taxes is going to have to go to servicing the debt, and at that point, now we're in like big time trouble.
Yeah, you're spot on. And another interesting tidbit that's sort of making the rounds in economist circles is that the neutral rate is pushing higher. So neutral rate basically is when if you were held at that rate, then it would neither boost economic activity or cause it to slow. So, like for example, prior to all the inflation we had, if they said that the neutral rate was around 4%, but you allow for 2% inflation every year, then the neutral rate would be around 2%. So economists are saying that that's pushed up into you can't measure it directly, like what it is, but it just makes sense that given how much inflation's been raging, that neutral rate has to have pushed up. So and will that remain for the long term? That's the question.
That's a good question to ask, and I mean, who knows at this point, because I don't think we've been in this sort of circumstance before. At least not as a country, we haven't. And I know that 5%, for the Fed funds rate is still considered, at least historically, somewhat accommodative. So that so I know at least in that way that keeping things at around 5% for the Fed fund rate is accommodative.
Yeah. Well, the reason I mentioned it was because King was talking about, deficit of the US government. I think the US government is running a deficit of 6% of your GDP at the moment. So, if that keeps going, then the only way to sort of cover those deficits is to increase government borrowings. And if yields are up as much as they are, like how are they going to continue to do that? So it's
Well, they're also collecting more tax as well. Like we
that is
can't.
true, but
Yeah.
will earnings remain robust? Like inflation's obviously going to fuel those earnings a little bit, but like will the consumer tap out, or will they be able to keep going? It's a quandary.
Well, if yields keep pushing up higher because of the U.S. needing to borrow more money to pay off its debt, which is ridiculous, um, I think it's going to get difficult for a lot of companies that are sort of on the edge, because they need cash and now they have to, take a 5% hit. It's not going to look good. So maybe that manifests next year, at the end of Q1.
I don't know. The way I think about it is like for us three, it's neither here nor there, except for the fact that it's going to probably cause a lot of bargains in certain sectors. And already we're seeing, like I think Wiz, you were saying a fortnight ago, that we're seeing the tech companies sort of come off a fair bit. I know one that springs to mind, which we're all familiar with, is PayPal. I've referred to it as a cursed stock before, and this is general in nature. Do your own due diligence, but PayPal coming off so much already and in the face of further trouble, like it's starting to look like an attractive buy for me. There's more. I want to do a bit more research on it, but that's the sort of that's where my head goes. So there's always opportunity in these scenarios, but yeah, I'm sure it'll push further into other sectors and other companies.
If it makes you feel any better, I could totally give PayPal the King stamp approval as a longer term buy at the moment. Yeah.
Yeah, absolutely. Have you been looking at a King, or is it just like anecdotally?
No, PayPal is in one of those unique situations where they already have the name and the market dominance, and they serve a function that isn't going anywhere anytime soon, and they only have um, there's a couple of different dynamics of it, but basically the same reason why Walmart's at an all-time high right now. Like you're going to get trade down. Well, at some point in time, people are going to need credit, and they're going to need to get it from a place. And online purchasing, PayPal is kind of, top dog, whatever you think of them. I think they're positioned well for bargain hunters for online trade down.
Yeah, absolutely. Like I think, in particular, that one is something I'm keeping an eye on. And you mentioned like Walmart, or you think about those other defensive stocks, which I think are like nowhere near a buy at the moment, just because they tend to perform so well in a recession. And whether or not we have been in one, or are, or continue to be in one, or there's like a worse one coming, it sort of seems like people have already piled in there as like a bit of a flight to safety. Yeah. In other news, in ones that I'm watching, I'm keenly watching, Ford's action with the union, with the UAW. Again, general in nature, do your own due diligence. But I sort of saw that they had to stop work on their battery facility development. So that hurts them a lot, and sort of keen to see that resolved.
I can tell you anecdotally that the Metro Detroit area where I live is we're experiencing some chaos at the moment. Yeah.
Yeah, I can imagine. Any ones that you boys are watching in particular?
Nothing beyond what nothing too new for me. I mean, I'm curious to see the extent of the Ford plant news. I'm not sure how bad that's going to affect the price of the stock, but it's not doesn't look good for the company right now. That was a major bullish catalyst for them.
Well, there was some good news coming out of Ford Wiz, because they had a new contract with the Canadian Labour Union, which I believe is
Yeah,
called Unifor. So they've ratified that, but it's still ongoing in the US, I believe. Obviously, yeah.
yeah, that's we'll see how that pans out. But the I know the battery facility was a big deal, just because people, the whole EV push. Maybe it's not. Maybe EV mania is finally over because now it's all AI.
No, it's not over. I think the way I see that is the way I see that is that it's bad news, because Ford in particular, and probably GM, like they need to scale that up quickly to compete over the next 5 to 10 years. I think Ford in particular has done a good job of preparing themselves and placing themselves well, but it's still one of those markets where it's not, I'll put it this way, it's not their most profitable segment. In fact, they're probably losing money on it still, but they still need to scale it and try and get it to profitability. So I don't think it's as big of a deal that people are making it out to be, but that also depends on how long it's offline for. You wouldn't want it to be a long time, you know what I mean? So yeah.
Well, it's bad timing because Toyota like literally just started selling 3 months ago, 2 months ago, they started selling the BZ4, whatever alphabet soup that they came up with for their EV. So that's their first push into the EV market, serious push into it. I'm curious as to see what the sales numbers on those are. There's a new refresh in the Hyundai line. Honda has yet to come out with their full EV line, but it's coming soon. So depending on how long this goes, unfortunately for the big three, they don't have a choice. Um, they kind of have to play ball with the union here because the union is enjoying the public support, and every day that they're not making cars, they're pushing the price of new cars up and increasing the margins for their competition who don't have to deal with the unions. The Toyotas, the Kias, the Volkswagen do have to deal with unions, but they already have. So this is a good timing for the union and a bad timing for the actual companies.
Yeah. Yeah, I think so. And I think obviously it's been bandied about on X.com that another beneficiary of this is Tesla. But I guess anyone who's not one of the big three, Ford, GM, or Stellantis.
I would give Tesla the nod on that, except for I don't have hard numbers on it yet, but there seems to be a lot of buyer remorse from people who bought in the last 2 years, just because the price of their vehicles is now like 30% lower than what they paid for their vehicles. And
Yeah.
they're like, why did I do this? I'm never going to be able to trade this in. I'm underwater to the point where this car is never going to be worth anything.
It's actually like a huge criticism I've got of Tesla. And I know, I mean, it's definitely not an original thought. Like I read this online a lot, that Tesla doesn't have like a PR team. And like Gary Black, I think you're both familiar with him on X.com, formerly Twitter, has said this for years and years and years that Tesla should invest in PR, advertising, marketing to combat issues like this. Because like the fact of the matter is, every car company changes their prices. It's just that in the structure that is the legacy auto, it's a bit opaque from the manufacturer to the distributor to the showrooms, and then how they manage it with their variable marketing budgets. So the price of those cars is in flux, but to the consumer, it appears relatively stable. Tesla obviously is out in the open with it. And I understand completely. Like if you bought a car, 2 years ago, and then it's already lost like 40% of its value for no other good reason except that Tesla's doing price cuts out in the open to compete or stay super competitive in the tough macro conditions, then yeah, you'd be pissed off because if I had just waited. But that is it's a sign of the times, and I think one thing from that is I don't know exactly how it will be managed, but I've heard a lot of banter online about legacy autos wanting to move at least in part to a similar model, so they get a benefit from their dealerships and the service that goes along with that, but also they see the margins that Tesla makes with their direct sales model or agency model, whatever you want to call it, and they want that for themselves. So I wouldn't be surprised if in the future the EV lines are all done in a similar manner.
All right, it just feels like I guess we'll find out, but to me, I'm not sure we want to completely move away from the dealership model we have in the US. Uh, it's a point of history with automobiles, and the reason why we have it is because back in the day, when automobiles were relatively new, there wasn't this availability of parts everywhere, and getting new parts for your vehicle could be difficult because the company's in California and you're in New York, and for some reason you bought a car that doesn't have a local manufacturer in New York, and then maybe that car company goes out of business, so there are no new parts. And so that kind of led to, having original manufacturer parts and all of that so many decades later. But it's at the end of the day, you still need to be able to replace parts on your car and go to a service center at a dealership. Um, at least, a service center where they're not going to cancel your appointment as you're en route to the service center. I mean, I've read those horror stories that happen all the time at the Tesla service centers. And, I just don't see how you can keep without keeping the dealership flush with cash and taking that margin hit and then keep your service center, fully staffed. I don't know. I'm running out of I don't think high margins are good for cars.
I mean, if it's sustainable, good,
Well,
good for shareholders.
high margins in a highly industrial setting like car making, they tend to correct themselves because there's there's just too much. There's just like there's a point where you're making too much money on the car, and it's just then it becomes too easy for other manufacturers to come in and undercut you. And brand loyalty is still a big thing. Like I know Tesla enjoys a lot of brand loyalty, but there's a lot of people out there that will only buy a Ford because maybe their family worked for them, or maybe that's what their grandfather gave them as their first car, or, whatever. There's a lot of brand loyalty out there, and it can be difficult to expand into major numbers. And when I mean major numbers, I'm talking like 10 million cars a year, not, oh, hey, cool guys, we hit 1.6 million, we're a big time player now. No, I mean like big time numbers where you're selling, multiple brand segments, and you're able to penetrate into markets all around the world, not just the big markets. And like I said, it's self-correcting. At some point in time, you invite the competition. I mean, notice that no one really got serious about making EVs until Tesla started hitting margins that were double digit, and then the highest in the industry. And that's when everyone else went, oh yeah, look cool, let's get in on the EV thing. And then now there's 150 different EV models, but there was what, 3 companies that were making EVs at any point in time in the 10 years prior to that.
Well, the number one thing I hear from people is that the cars are ugly. They don't like the interiors. They don't like the look of the car itself. Of course, there's what the car is, which is an electric vehicle, and that is the major appeal. But it's basically the same car in 3 different models. There's nothing unique really, except for the fact that you have more seats, or maybe it's I think the most original looking one's probably the X, right?
I actually think you're saying that with the benefit of hindsight. I think like the models are getting quite old now. I think they were very innovative at the time, and the minimalist style of the interior of a Tesla is now being replicated in a lot of other brands. Because
Well,
it was like,
it's not the style; it's the actual physical look of the car.
yeah, sorry,
You
I don't
can
mean
take, yeah.
outside. I mean on inside. You were mentioning inside.
Oh,
I've heard a criticism that people don't like the fact that there's no physical buttons inside the Tesla, but I reckon that's all consumer preference. But I do think that minimalist style in the interior, even though
well,
Tesla's very minimalist, I feel like a lot of models now have adapted the strong points of that, like having this touchscreen in the middle. Like most new cars have that now.
well, that was something happening, sort of at the same. They're all all manufacturers were kind of going to the central touchscreen style. It's just the rest of the buttons have finally started to go away because they added a lot of confusion, for a lot
But
of
but
people.
if you're selling the same basic model without a meaningful refresh for more than 5 years, it better be named a Camry or a Civic, because otherwise you're I mean you're running into people going like, wow, I can't tell. When I'm driving down the road, I cannot tell the difference between a Model Y that was made the first year it came out and a Model Y that was made today. I cannot tell the difference between the two. And there's no reason why after 5 years I shouldn't be able to tell the difference between the two, because I can tell the difference between every other car out there, including a Civic. I can tell you what a new Civic looks like compared to a Civic from 2016 or 17.
I think
But
next, sorry, go on, King.
no, I'm just saying, like, you have to do a refresh, and even if it's just a cosmetic refresh, you still have to do it. You have to and that's where I'm saying is like profit margins tend to be self-correcting, because if the reason they have these margins is because they're using the same molds that they had from 5 years ago. They're using the same parts basically that they had from years ago, or they've taken parts out, um, and are selling the same car minus the parts.
Well,
But
even parts is a good discussion. Just a quick point is even within the same run off the assembly line, you can have different parts from different manufacturers because they don't manufacture all their own components and they had to source them. And so to source them very quickly a few years ago, I'm not sure if it's still a problem now, but they had different parts put in. So even when you would go get it serviced, they would have to find the right part to replace. And sometimes they just didn't have it because they changed so frequently.
Speaking
And
on, oh, sorry, go on, Wiz.
oh, so one last point to circle back to the interior. I'm not against the minimalist style. I mean, it's criticism I hear about it. I'm fine with minimalism, but to me, it's just
Yeah,
I'm
you
not
are.
sure if I'm not sure if when I
That's-
when I get in the car, I don't feel like I'm getting in a luxury vehicle, right? With I feel like I'm getting in uh, something that's
A
trying.
sterile environment.
Yeah, I mean, it is what it is. It's fine. I will drive any car. I will sit in any vehicle with cloth seats that are 20 years old and have been baked with vomit in it, and I'll be comfortable. But because the car to me is just a thing to get from A to B. But I can understand why people look at the interior and say, "This is all the money. This is all I'm getting for this." It does need a bit of pizzazz or wow.
yeah, I was
Not
going to
to
say,
completely I'm sorry, not to completely derail us, but you said vomit, and it immediately made me think of all the IPOs that we've had in the last week or two here. Um, sorry, what a segue that was.
well,
We
before
should.
let's chat about quickly. But one thing I wanted to say, just to round out that Tesla conversation, the refresh. There's a Model 3 refresh coming next year, 2024, and Cybertruck is starting delivery. So I understand what you're saying about like the time frame. Like obviously, other manufacturers would have a shorter time frame to refresh, but Tesla's getting there. But yeah, do you want to talk about ARM? Because I feel like that's the big IPO. I haven't actually kept up with the price. What's happened with ARM? Have you boys
Everyone
kept up with
lost
it?
money.
I haven't looked at ARM because I just didn't want to be tempted into a bad choice.
That is so wise and all a similar thinking to myself. So it looks like the day it IPO'd, it was around $63 roughly. And then it got down to 51. That was on the 22nd, so on Friday just gone. And now it's up again like a couple bucks, but it's down 14.3% from when it IPO'd.
It's
I
just
mean, if
another
you were
cash
lucky
cash
enough
and
to be
grab.
like Warren Buffett and get in at, the original IPO price, then I guess you're not doing so bad. But yeah, 59, I think, is where the actual trading started for everybody at retail.
Yeah, I what I think is funny is listening to Jeremy Grantham talk about the accidental SPAC he got into and how he had to he kind of weathered that a bit because he wasn't allowed to sell or do anything to hedge, and I think it went up to like $150 a share for whatever he was in, and then I think he still got out with like 10 times his investment. But it's really comical to hear how much of a scam and a fraud these IPOs are now.
Well,
Like,
Instacart was the other one, right? Like, have you the
yeah,
price action on that on day one was up to almost $40, and now it's down at 30, 39. So just a cool 25% ish off the top.
it's not bad, but I just don't. I'm not familiar with Instacart as a company except for the fact that it allows you to steal more readily from supermarkets.
It does what? What?
Yeah, it's the scanner, right? Instacart's the scanner you
I
walk
thought
by, or
I
I
thought
think there's something
Instacart
else.
was like I'm not familiar with either, but I thought it was like you buy your groceries online and they deliver it to you.
Oh, okay. Maybe, yeah. If that's what it is, I would say it's probably a buy because then I've used them and I think I might have used them with Costco. I'm not sure. See, I don't keep track of the services I use when I don't have to make an account. It's just like it's one less thing for me to remember. So
But would you buy Instacart at the multiple that it IPO'd at compared to Uber Eats? Another
No,
service that's already
well,
there and is on the precipice of profitability and is at a lower multiple. I mean, I don't know if they're at a lower multiple now because Uber's price actually recovered quite nice, but
I would say that I would not want to own Instacart at this valuation right
so
now
so
because
Instacart,
I
it's
just
at
don't know what everyone else thinks it's worth, and
it's
that's really what I'm gonna
8.4 billion market cap. Sorry to cut you off, Wiz, but I just wanted to clarify that it's 8.4 billion is the
know.
valuation currently.
which
Yeah,
is insane. I mean, that's you're back to no. I mean, you're back to what physical assets do they have? Like that. I mean, that's the other issue that we still have with a lot of sorry, I'm from the .com bubble era. Like you have to look at it as is what is this company actually worth? Like how much is the software actually worth? And if you want to tell me that Instacart's model, software, and customer base is worth 8 point something billion dollars, I would need that in some kind of a PDF so I can read it or something because I don't know, man. There's too much competition for multiples to be this high on companies like that. Like ARM, the reason why they IPO'd so high was because their multiple was based on, well, if Nvidia is trading at this, ARM's got to be worth at least this. Well, they're not even the same kind of company. I mean, yes, they are, but they're not.
So on a napkin math, the multiple on Instacart is 21 times their earnings. They're doing that.
Now, right?
Yeah, now, but it says here, and I'm not familiar with this. Again, general in nature. Do your own research. It's saying here that their revenue last year was 2.5 billion. So that's encouraging. I also know from our friend Clay that SoFi is a backer in this. I think they have a stake in this IPO. But again, I don't know the product.
I would say that it would be good to see where it goes. I mean, maybe it's worth about this in another 5 years. So if you've got the patience to sort of DCA over 5 years to earn nothing or 5, 10% if you buy a lot lower. I don't know. I guess we'll have to find out where real value is.
I don't know how much you can trust these figures, but it's saying that it went from in 2019, 214 million in revenue, 2020, 1.4 billion, 2021, 1.8 billion, and then 2022, 2.5 billion. So that is some enormous growth in just 4 years' time. Maybe the 8 billion. I mean, if it keeps going that way, maybe the 8 billion valuation is an absolute steal. But yeah, I don't know.
It could be. I think it depends on the marketing and contracting. They're savvy, how savvy they are with that. Because if they can lock in certain larger, stores or retailers to use their service for delivery, then I think then that's something to look at. Because Uber Eats, for example, is they'll go to any place and order for you and pick it up, right? But I mean, I don't always like what they do when they grocery shop for me. So I think it kind of is going to kind of depend on if people really trust other people to grocery shop for them or pick certain things out.
The thing about
I'm
Uber,
not
though,
sure if I'm reading this correctly or not, but the 2022 numbers that I'm seeing that 2.5 billion and revenues you were talking about, but that on that they only made 62 million net.
Hey, at least they didn't lose money. I have to say that.
Correct, because I just mentioned Uber, and then I looked at Uber and I realized that wow, they still have a negative 200 PE. So it's like okay, whatever.
So
I was
yeah,
about
I
to I
mean,
was about to say on Uber, I wonder how much Uber makes off obviously the ride share, but how much do they make off groceries and Uber Eats? Because
Well,
yeah,
they
that
made a ton during the pandemic. It's shifted back into rideshare again.
interesting. Final thoughts, boys, on everything we've discussed today. Man, this went quickly, but yeah, good.
I feel like a part two might have to come up
Yeah, we can do a part two.
because
I
I think
I want to warn everybody that markets are irrational. And we've seen that for the last couple of years now. We've seen irrationality in both directions. Just be careful. there's too much predicting going on in the stock market that contradicts the predicting that's going on in the bond market. And my opinion has always been the bond market's the one that's right. So just remember that when you're looking at the evaluations and the people that are telling you that it might hit 5,000 this year.
Mm.
Eh.
In my final thought, I will echo that because, the yield curve's been inverted for a while. Yields rising is lessening the steepness, if you will, of that inversion, but it's still inverted. And, 10 times out of 10, after a yield curve inversion, we have a crash, and that hasn't really hit yet. So
Yeah, and don't forget that it normally starts to uninvert before the recession.
that is right, yeah.
And I just have to say, watch and learn.
Because the whiz is coming. He's back, baby. He's back. All right, we'll sign off. That's We Hate Money, episode 5, and we will have a little powwow about whether or not we do a bonus episode. Cheers, all.